Whenever a company drops its earnings report, all eyes, I mean all eyes, jump to one single number, earnings per share, or EPS. We've all been trained to see it as the final grade on a company's report card. If that number's going up, hey, the company's got to be doing great, right? But what if I told you that single number is one of the most masterful illusions in all of finance? Today, we're pulling back that curtain.
Okay, let's get right into it with a little puzzle. Picture two companies. They both come out and announce, hey, we grew our EPS by a fantastic 20% this year. Now, logically, you'd think their stocks would react pretty much the same. But then one company's stock doubles while the other gets chopped in half. So what gives? This isn't some glitch in the system. This is the market telling you it knows something you might not. I mean, just look at this. On paper, Company A and Company B look like identical twins. Same performance, yet one gets a standing ovation from investors, and the other gets booed off the stage. Why? Well, it's because the market isn't just reading the headline. It's digging deeper. It's analyzing the quality of that growth. And in the next few minutes, we're going to show you exactly how to see what it sees.
So let's start by busting our first big myth, the idea that any and all growth is good growth. It's just not true. Probably the best way to think about the quality of EPS growth is to imagine it has a blood type. Yeah, a blood type. Some types are healthy, sustainable, life-giving, and some are pure poison.
When you really boil it down, there are only 4 ways a company can make its EPS number go up. First, it can grow revenue by actually selling more stuff. Simple enough. Second, it can expand its margins, basically by becoming more efficient. Third, it can use a bit of financial engineering, like share buybacks. And fourth, it can get a temporary sugar rush from a one-time gain, like selling off a factory. Each one of these tells a totally different story about the company's real health.
All right, let's rank them. Type A, that's real revenue growth, is the gold standard. That's the engine of a truly thriving business. Type B, margin expansion, that gets the silver medal. It's good, don't get me wrong, but there's a limit to how much you can cut costs. Type C, share buybacks, that's bronze. It can look pretty, but a lot of the time it's just an illusion of progress. And Type D, those one-off gains, that's the poison. It's often used to cover up the fact that the core business is actually sick.
Now, this is where it gets really interesting. Let's see how a company can literally pull EPS growth out of thin air using that Type C method, the share buyback. We're going to walk through a super simple example. Just imagine a company makes $1,000 in profit, and it has 100 shares out there in the world. Simple math, right? $1,000 of profit divided by 100 shares, that gives you an EPS of 10. All good, solid year. Okay, now fast forward to year 2. The business stalls out. Profit is completely flat, still just $1,000. But the management team, maybe looking at their bonuses, decides to use company cash to buy back 20 of its own shares. They basically just make them disappear. And boom, just like magic, look what happens. The profit, the actual money the business made, hasn't changed one bit. But now it's being divided by only 80 shares. So the EPS jumps to 12.5. That's a 25% increase. The headlines might scream, EPS soars 25%, but the business itself didn't grow at all. So here's the key, always check if the growth came from the top number, more profit, or from shrinking the bottom number. All right, let's switch gears and tackle our second big myth. The idea that a negative EPS, a loss, is always a sign of failure. This is a huge misconception, especially in today's economy. In fact, sometimes losing money is the absolute smartest thing a company can do. It's called a strategic loss. Think about a subscription software company. They might spend $100 today to get you to sign up for their service, but you only pay them $10 a month. So in that first month, their books show a $90 loss on you. But if you stick around for 5 years, you become an absolute goldmine for them. And what this creates is a really cool visual called the J-curve. You see the company's financials take this big intentional nosedive as they spend a ton of money to grab all those customers. But once that customer base is locked in and all that recurring revenue starts pouring in, profitability doesn't just recover, it shoots for the moon. That initial loss wasn't a failure at all, it was an investment in the future. So how can we tell the difference between a smart strategic loss and a business that's just, bleeding out? Well, there's a fantastic little shortcut the pros use, especially for these kinds of businesses. It's called the Rule of 40. It's easy. You just take the company's revenue growth percentage and you add its profit margin percentage, even if that margin is negative. If the final number is above 40, that's a really strong sign that the company's making a healthy trade-off.
And now for our final and maybe the most important myth of all, the belief that EPS is this single objective number that's carved in stone. The truth is, there isn't just one EPS number. Companies often show you two versions of their earnings, and the difference between them can tell you pretty much everything you need to know.
And honestly, the best way I've ever heard this explained is like this. GAAP EPS is the official, by-the-rules number. It's like stepping on the scale at the doctor's office. The number is the number, period. Non-GAAP EPS, on the other hand, is the number management wants you to see. It's their social media post, you know? After they've said, well, my jeans are kind of heavy and I'm holding a bottle of water, so let's just subtract those. It's the feel-good number.
So what kind of stuff are they subtracting to get to that feel-good number? Well, the biggest one, especially in the tech world, is something called stock-based compensation, or SBC. This is just when a company pays its employees with new shares of stock instead of cash. And the argument they make is, hey, no cash actually left our bank account, so it shouldn't count as a real expense. But that, my friends, is a very, very dangerous trap. To see why, just imagine the entire company is a pizza. Before they hand out any new stock to employees, you own your slice of that pizza. But when the company creates new shares out of thin air to pay people, they have to recut the whole pizza to make room for those new shares. Now, see what happened? The pizza itself is the exact same size, but your slice, it just got smaller. That's called dilution. And it is a very real cost to you as an owner, even if no cash changed hands. And hey, you don't have to take my word for it. Warren Buffett himself famously called out this nonsense. He asked, basically, if giving someone stock isn't compensation, then what is it? And if compensation isn't an expense, what on earth is it? It's an accounting absurdity. So here's the bottom line. Always look at the gap between the official gap number and the company's adjusted non-gap number. A really wide gap is a massive red flag. So if EPS can be engineered with buybacks, if it can be negative for perfectly good reasons, and if it can be polished up with all these accounting tricks, what in the world can we actually trust? Well, it's time to stop looking at reported profit and start following the real money. It's time to talk about free cash flow. Free cash flow is the ultimate truth serum. It's not some accountant's opinion. It's the cold, hard cash the company has left in its pocket at the end of the day after paying for everything. Salaries, rent, new machines, the whole shebang. Remember this, profit is an opinion, but cash is a fact. And it's way, way harder to fake. And look at how this plays out in the real world. It's a night and day difference. A company can report a spectacular profit of $100 million, which makes for a great-looking EPS number. But then we follow the cash. We see that 80 million of that so-called profit was just IOUs from customers who hadn't paid yet. And the company also had to spend 50 million on new equipment. When you follow the actual cash in and out the door, you find out this profitable company is actually burning through money with a negative free cash flow of $10 million.
Okay, so we've torn down the myths, we've revealed the story behind the numbers. Now let's pull it all together into a powerful toolkit, a checklist you can use every single time you look at a company's earnings report.
From now on, before you ever get excited or panicked by a headline EPS number again, I want you to just ask these 5 simple questions. What's the blood type of this growth? Is this loss a smart investment or a failing business? Is management trying to hide something in that non-GAAP number? Are they quietly shrinking my piece of the pie with stock compensation? And the final, ultimate reality check. Where is the cash? So the next time an earnings report hits the news and everyone is obsessing over that one number, you'll know better. You'll know the headline isn't the end of the story. It's just the beginning. You'll know to look deeper, to check the quality, and above all else, to follow the cash.